All righty, welcome everyone to the daily macro update for Thursday, April 10th. We got a special episode for you guys here today. We have Zachary Loft on the call here today. We're going to be talking about the housing market here. For those of you that don't know Zachary, he has a pretty prominent presence on social media with talking about all things housing market related. On TikTok, he's amassed over 1.7 million followers. And, same thing with Instagram here. He's been someone who's not only been on, just updating, but he also has a great stance on, fighting against the institutions that are essentially taking away a lot of the, different opportunities that younger people like us are kind of falling behind on, right? And so if you guys haven't already, definitely check him out. But we're going to be talking about not only his viewpoints on a lot of the different topics that he's been talking about recently on the housing market, but also as well, this man has developed an awesome tracker for the housing market. And Zach, when did you release this? This was recent, correct?
This version of it, yes. Yeah,
Gotcha.
we started it initially when he got inaugurated, but realized very quickly it's a pretty dry document if you only have the baseline and nothing after it. So this is the first version with, like you said last week, I believe it was, with
Gotcha.
the starting metric and the current metric.
Cool. All right, awesome. Yeah, we'll definitely get into that. And we'll be getting into some of those questions here, but just for the audience, quick macro update. The S&P 500, crazy volatility lately with all the Trump stuff. With volatility spiking and remaining above 30, this really isn't a time to do any type of captain stock picking that's going on. And yesterday was an amazing chance to get rid of some things that were up on a pop, such as Bitcoin, the S&P, things like that. But this is what happens during bear markets. You have huge bounces. And, this is not surprising. Yesterday's bounce was one of the largest that we've seen since 2008. But the harder they fall, the bigger that they bounce, right? And so it is interesting seeing, the dollar come down. This is signaling to me that Powell might be cutting rates soon. It is interesting. This is happening at the same time that 10-year yields remain higher. This is something that also Zach talks a lot on his videos about, which is, a lot of lending, especially with like mortgages and, credit card rates. Those are all, reflective of the 10-year U.S. government bond yield, not the actual Fed funds rate, which is for some reason, that's what everyone's obsessed with. But yeah, this remains elevated, which is pretty interesting. And as long as the VIX remains, well above 30 right here, you want to be very careful. But taking a look at some other things before we get into the discussion here with Zach, as of right now, there's a 73% chance that they remain paused. I was talking about the Fed meeting, the Fed minutes that were released yesterday. And the Fed during their meeting minutes, they always try and just gaslight us. It seems like every single time. I don't know what it is about the elites, but they basically said everything is robust, strong, everything is Disney World, fantastic. Yet there's a lot of turmoil in the markets right now, so not really too much on that end. They might pause quantitative tightening during the next meeting. But as of right now, there's now a 63% chance that they cut by 25 basis points by the June meeting. So they're obviously pricing in something between now and the June meeting. As of today, we just got CPI this morning. Headlines 2.4%, meaningful tick down, second consecutive month. Same thing with core inflation, which that's the lowest level since April of 21. These are rates, by the way. Cumulative inflation remains at all-time highs. So just because the rate is coming down doesn't mean inflation's coming down. Tying it into this discussion here, when we take a look at the shelter component, that remains near 4%. Still, slightly above the pre-pandemic average from 2016 till the pandemic, but still, that remains coming down. Housing is around 3.7%, which is well above the pre-pandemic average. So we're still seeing a lot of, even though the inflation rate is coming down, you're still seeing persistent inflation as far as an aggregate level when it comes to the housing market. And so, a couple of tickers that you guys can just keep track on in terms of, what supply is doing. So home builders, the home builders ETF XHB, this continues downward. And so, obviously there's a lot of supply constraints and things like that. But it is interesting how this remains in a bearish trend, and it's been bearish really since November. So the housing market continuously seems like it's in a freeze. And so that'll be a good segue into this discussion here. But yeah, Zachary, hopefully I was doing a good job with characterizing, what you do and how you do it. Folks, Zach's been doing this for quite some time. I was talking to him before we started going live here, how I've been a fan of his. So it's a real treat to have him on here. Hopefully this will be, one of many. But yeah, Zach, appreciate your time, brother.
Appreciate the invite, Brendan. I think you nailed it as far as the intricacies that are going into what's going on right now. We're seeing rates go potentially down on the Fed side. We're seeing while the 10-year Treasury yield goes up, the dollar weakens. We need supply, but builders aren't seemingly building. We're not seeing building permits come through. You just showed the home builder ETF. It's weird. And I would be curious your opinion. I think it has so much to do with volatility. No one knows what's going on.
Yeah, I think the uncertainty surrounding it is one thing, but it is really interesting. And this kind of goes into the first question that I had for you was, with the supply and dynamic that's going on, you'd think we'd be in a housing recession right now. I guess in your view, and I guess from what you've studied, I guess how come prices in the aggregate aren't coming down as fast as I guess one would think, seeing that demand has just completely been at 20-year lows?
There's a few reasons. The first one I love to go back is historically why have other markets crashed in the past. And I think one reason we expect a housing recession is because most of us lived through the last one. But many people haven't lived through two, because the last one before that was the Great Recession in 1931 to the 36 period. So it's not common to see the housing market turn on itself. It's interesting because it's one of the only commodities, especially at scale, that doesn't have a CEO. It's privately owned at macro. It's all private owners wanting to make as much as they can, buyer trying to get a good deal, seller trying to get a good deal.
Interesting.
So we have this second effect that's come from the low rates we had, the cheap money. If you look at a finance map to see when people originated mortgages and when people refied their mortgages, if you look at a map and it shows 2020 to 2022, you'll be like, whoa, this is a giant waterfall of people. And the number is staggering, the amount of people that are still only paying $1,200, $1,500 a month that will not sell. And people call it the lock-in effect. And so we're not seeing that resale inventory, which is pivotal to seeing any type of correction. The third is we're not building. We're not building. And you can draw this out to zoning. You can blame the regulatory costs. You can blame impact fees locally. Whatever you want to blame, I personally think we should build up. We're not seeing enough units get built, especially affordable units. We are starting to see on the Trump tracker, it shows that we're starting to see that slight uptick. And it's been an uptick really since that October, November-ish of homes beginning to sit. But most of those homes are well above the median average, 4-bed, 4.5 bath homes. And I believe we are absolutely walking into a world where we have a better chance at home prices doubling than crashing. And that's not what a lot of people want to hear.
Yeah, I definitely want to highlight, this issue right here, which is, and this might be, let me see when this was produced. This was December of 2024. So just a few months ago. Yeah, roughly 60% of current homeowners are still locked in to rates that are,
And that's
well
not to
below.
interrupt you, Johnny. Only 60% of current homeowners with mortgages. 39.6% of homes in America don't even have a mortgage. They're owned free and clear. So when you
Really?
think about 2008 and the bank crisis that led to the squeeze, that led to these adjustable rates on people that shouldn't have had mortgages in the first place, these
Mhm.
ninja loans, just like whatever you make, just write it down, we'll accept it. You got a heartbeat and a credit score loans. And you had people who shouldn't have owned a home in the first place. And now you're kicking in a higher payment on them out of nowhere. That's what caused the '08, and we don't have that formula now because people can afford their homes. Since 2009, it got so much more difficult to get a mortgage. The people in their home can afford their home and a little bit more. And this point is great because when you see that, I've seen the number actually quoted higher. And when you go into who's below 5%, it gets into the 80% ranges as to nobody is in a tight spot right now. Anybody and their mother refied when rates were low. And a lot of people, like the people that we serve here in Delaware, got in when money was cheap.
Right. Yeah, so you have existing homeowners not wanting to sell because there's really no incentive, and rates are so high that it's just too expensive for even new homeowners, which the irony is, if you were taking the quality of people looking for a home, they would easily get a home just 20 years ago, right? Because like a lot of them,
Oh,
the
man.
standards are a lot tighter nowadays, and most people nowadays, even though they feel like maybe I'm behind because I don't have a home, which that's a whole separate category on like materialism, spirituality. We can maybe get there if we want, uh, but when it comes to just the quality of someone, with their credit scores, their income level, it's quite ironic how back then someone who is like a low quality, I guess, borrower was able to get a home pretty easily, whereas now it's like a very high quality borrower is priced out.
Yeah, really all the way up until, I mean, you hit that phase in 2009. Barack Obama signs into order this new strengthening of the mortgage process, and it's lending overall. It's not just mortgages. And since then, up until 2022, you can look at the National Association of Realtors. They provide an affordability report. It's based off anywhere between 50 and 150, 50s in the middle. And for the longest period of time now, we have been well over 100. But it's only been recently, 2023, 2024, and currently 2025, that affordability report traipses down. First time homebuyer affordability is at a 66, I believe, still. And there were people, man, when I got started, I was just shifting off mortgages to people I graduated high school with, people I was in the military with, one full-time income, decent to normal debt. So what this ratio does here, this what you got up on the screen,
Oops,
it
sorry.
basically takes what the median family income makes and then looks at the median home in that area. And what I especially like about this report is the regionality. They show Northeast, Midwest, South there at the bottom. And you can see, like, if you look at the Northeast, it's obnoxious. The median home is 489. The median family income there, four over, is 112. But the qualifying income for that very home is 13 grand higher.
Oh my gosh.
It's like written in black and white. And then you look at a year ago, a month ago, and this month, they're all trending down from a year ago, which a year ago you would have asked a lot of people, hey, is it an affordable housing market? They would have told you no. Well, guess what? It's worse. And the part of it all it comes down to is this is income. This is a wage problem. People do not make enough. And it's leaving us in a world where people are being looked at looking renting down the barrel, and I'm sure you're going to bring it up at some point. But companies like Blackstone and private equity are seeing what's happening in front of them as a world that's going to shift more toward the need for affordable rentals. I see the one comment that came through on my side. I don't know where the comments go. But I saw one that came that said, "Is BlackRock buying up everything? Their rent neighborhoods is that an issue?" Yeah, they are beginning. Blackstone, by the way, owns more residential property than BlackRock does. Blackstone owns 300,000 units. But BlackRock and Blackstone both buy builders and they buy companies like Tricon Residential that are building neighborhoods specifically for rent. I think they see the writing on the wall. We're going to need rentals. People can't afford housing. And there's not a lot we could do right now to break that trend of either it's just going to be really unaffordable or home prices are going to go up. Because if we keep rates high, it'll just remain unaffordable and the wealthy will survive. And if we bring rates down, well, we see the secondary action of that, which is demand will go up and prices will go up because we don't have enough houses on the market and people don't make enough.
Yeah. Wow, that's a great characterization of really what's going on here. And you don't really hear too much about how a lot of these huge funds are just coming in and um, just sweeping through and taking a lot of these single family homes in order to rent them out. I don't know if you had any references that I can look up real quick, but my
Yeah.
question is like, and I think you've mentioned this in a different video, but I think it was when you were critical of Dave Ramsey talking about like it's it's not the fault of these big companies or whatever. But what's like the percentage? I don't know if you remember off the top of your head
Sure.
of like how many of those
Yeah, it
homes.
goes tier 1 to tier 4. Tier 4 are anybody who owns more than 1,000 units. Tier 3 over 100 to 999. Under 100 to 10 is tier 2, and then tier 1's 10 or less. So tier 4 is what like a Blackstone or BlackRock fall into, and it's anywhere between 1 and 1.5% of the homes that are purchased by private equity or people that are considered institutional investors. They only do this for that purpose. But the percentage of people that are buying in the 1 to 10 range, they have 2 properties, 4 properties, 5, they're considered the mom and pop investors of the world. They
Right.
buy 19.6% of the houses.
Wow.
Now, there is the devil's advocate. Zach, how do you know those aren't shell companies that are disguised under BlackRock? I don't. You're absolutely right. Our corporate system right now, the way you can go get an LLC out of my great state of Delaware and guise your appearance to buy pretty much any asset you would like is weird and should be probably reworked. But going back to who controls those laws, probably won't. But the big deal about Blackstone and BlackRock is the overarching of they fund the builders, they fund the title companies, they fund the inspection companies, the HVAC companies. They fund everything that goes into the home. They're not necessarily the ones always walking to the closing table on it. For example, Tricon Residential, somebody that you could look up, they build to rent neighborhoods for them. They're currently building in Texas and California. You could see that Blackstone is operating in a world where they buy whole conglomerates like Home Partners of America that own 80,000 units instead of actually walking to the closing table one by one by one by one by one. They're not in that business, but they are in the business of owning the companies that own the portfolios. Because when you get that big, it's too slow to go one property at a time.
Right. And a lot of these different builders too, what they're doing is they're saying a lot of them are giving out like those special like builder mortgages, right? Where it might be a little bit under the rate, the current mortgage rate. I think.
Absolutely. Yeah, they're basically taking on a security line against their portfolio. And you're only looking at a 1 to 2, maybe 2.5% at max loan. And this is one big issue that a lot of people take with private equity is loans like that, security backed loans, or security line back loans, as well as leveraged buyouts. They get better rates that are also adjustable. So there's been this thought now, and even some economists have gone out and said that we need to prepare to bail out private equity, which is a wild thing to conceive. But when private equity comes in and buys 8 to 12 business with a leveraged buyout fund where only 70, or I'm about to say 30% of the money is theirs and 70% is leveraged from a bank, and you hand it off to Toys R Us and you hand it off to Hooters and you hand it off to Michaels and you hand it off to Joanne Fabrics, and then rates go up. One, you're ripping their employees out, you're scalping them for parts and systems, and now you're expecting them to pay a higher rate. We're going to probably see corporate bankruptcy. I don't want to say skyrocket, but definitely trend up this year. There's a lot of companies in that position right now that are being held to the fire with debt that they didn't accumulate and that was put on them by private equity. And
How
I
is
do
it?
think that will bleed into the housing market.
Yeah, I'm not sure how any of that seems like legal at all, but
It's wild, man. It's wild. And of the 30% that they pay, most of that's money raised by their own investors. There's like a 5% usually that they're actually in. And guess what? When Toys R Us falls under, they don't lose anything. The money they make on the acquisition and the money they make for consultation for these companies while they're in there gets them the profit usually. And then they're able to walk away from it if it falls apart because they only lose the equity. That's all they lose. It just falls off their books. And it's like, okay, cool. But they invested in 8 to 12 at any one time. So if one or two fall apart, it's fine.
right.
You
Wow.
got, yeah, it is a weird world. I'll give you an example. Her name is Tiffany. She's a fantastic journalist out here in Maryland. She talked about this in Texas. I recently had it happen here in Delaware. Dude, our water stopped working. I don't know if you've ever been in the first world and your water stopped working with a well, but it's very humbling. You're like, whoa, whoa, whoa. I don't have water?
Yeah.
That's not right. I need water. Our well pump had broke, and we have a 200-foot well.
Mhm.
So we called up service today. Closest one that was available was a Saturday. No one else was available. Comes out, checks it out. Says, we got to do X, Y, and Z. And he turns an iPad toward me, and he says, it's going to be X. It's $14,000.
Whoa.
I am gratefully blessed financially over the years to not look at that and think there's zero chance we can make it happen. But I didn't want to make that happen at all. And
No, it's all
so,
chunk.
and he was a young man like me. And I said, I'm gonna call a few people and see if I can get this price. And he assured me right then and there, more than likely, that they were gonna come in with a similar price point. We had a little discussion about it, and through works of like Tiffany and others, I did digging on service today. And they're owned by a company that's owned by private equity. And I looked into the company that owns them, and about 12 of the 14 major companies in my area, Ocean City, Salisbury, Fredericksburg, Middletown, Wilmington, Delaware, all owned by the same company. And they have one software that feeds all of the children companies. The one parent company has this one. So whatever price this person gives is what the price that person's going to give and that person's going to give. And they slowly do it to A, kick contractors in the local area out, and B, price gouge the individual because now they have financing options. And they'll have you sign right on the iPad dotted line without presenting you a loan disclosure, which legally they have to, and they don't. And it's sick because it's happening everywhere. And I know we're here to talk about housing, but that's affecting, to your first point, the person that is hardly holding on to their home as it is. Imagine getting a bill like that and you're already scraping by. And we're
Yeah.
beginning to see that in FHA loan delinquencies. I will add that. We're at about 11% on FHA loan delinquencies, and that's anybody who's missing their payment by more than 30 days. So they've missed one payment. It's 11%. That's trending up. And if we see that get to the 17-20% range, we're more than so FHA would be, yeah. So this is a good one on book domestic, all commercial bank. Go back to that last one you were on because that was all delinquencies. That's a great one because on all delinquencies, yep, you can just click that one right there, right here. You'll see it's trending very low. You'll see it's not spiked nearly what we saw in 08,
Mhm.
1.77%. But if you look for FHA, which actually it's on my Trump tracker, if you wanted to go there, it's right. It'll be easy to find for you. In the bottom, it's the second metric for depression tracker. So with this Trump document, we are tracking the potential of a housing crash, and we do view the people in the FHA space as pivotal for
Right.
affordable housing because most people who are using an FHA loan are typically first-time buyers.
Yes. Typically.
Yeah, typically. Exactly. It's not exclusive, but typical. And that is an unfortunate sign because when you look at overall delinquencies, you'll see there's not a huge ding. But when you look at the people who are holding onto their home, maybe their first home more than likely for dear life, we're starting to see cracks. And that stinks in a market where first-time home buyers are having trouble getting in. And now we're seeing first-time owners are having a hard time sticking around.
Yeah. I think I saw something where in a matter of 4 years since the pandemic, I think the average, and obviously with housing, everything is, you have to look at it regionally and almost state by state, area by area. But even the aggregate numbers, the increase in the aggregate is pretty insane. It's almost like it's gone from like $2,100 per month to like an average of like $4,500 a month on average for just to own a home. I mean, it's pretty ridiculous here.
And where's your market?
I'm down here in South Florida,
That
so
makes complete sense. Southwest Florida is its own beast, man. I put a disclaimer when I talked about the national market. Like, if you're in Southwest Florida, this does not apply to you. You guys are crashing because it's
yeah.
weird. Your supplies upticked at a severe level, and you have taxes, politics, and insurance that's getting beaten around everywhere.
Yeah, it's a little crazy over here. We're in the southeast, so like Fort Lauderdale,
Very
like
nice. You're
Miami
away from
area.
Swiftle. Good. You're away from Swiftle.
Yeah, but still, it's pretty hot here. But that's a good segue as well, because I do want to, I do want to take a look more in terms of this Trump tracker here, because what I really like about this is not only does it give you all the housing metrics, but it also you have it separated by region. You also have different updates with policy, which is huge. You have this bill tracker here. And so what I want to do here is I want to just let you take the reins and go through a little bit on like how someone could use this. And as well as, maybe after we can talk about how my audience can get a hold of their copy as well.
Absolutely. Well, first off, for getting the document, it is an open Google Sheet viewable at any time. So I'll make sure that you have the link already. So if this is tagged below, I'm sure it is. This is going to be accessible. Now, in getting updates, we did create a get notified button at the very top. We highlighted in yellow. If you wanted to get updated on big updates, we just ask for your email, not your name, nothing else. You're not going on the list. You're not getting spammed, just for big updates if you want them. Otherwise, you can log in this document whenever you'd like. The way I would use it, if I'm a layman who is not in real estate day to day, I'm not neck deep in the data, and I look at this and I'm like, whoa, what does that mean? I would point you to start at the bottom right, the key three, the three numbers that really culminate the three main items that are being paid attention to. How many homes do we have on the market? Is the housing market affordable? And how close are we to a crash? The main reason we put these three is because we want to show people we're nowhere near a crash. We want to show people we actually do need supply, especially affordable housing supply, and just put numbers to what a lot of people feel, that this market just doesn't feel quite right, doesn't feel quite affordable. And the key three actually favors first-time homebuyer affordability and favors first-time homebuyer supply. We use the Federal Reserve numbers. We utilize Tradenomics. We utilize the National Association of Realtors to create ratios. And I'll point you to the depression tracker in the bottom. That's an easy one to talk through because this feeds that depression number over there. And I say depression because that's where we'd have to pretty much get to start seeing home prices go down 20, 30%. I don't think anybody wants that, but we're tracking it. So we have it labeled by category. Critical, major, and minor. We have the percent or active data piece logged in, most via an API from the Federal Reserve. So we have live up-to-date numbers. And based off that number, it fits on some sort of tier system. And we show that tier on the right. Is it a low risk, high risk, moderate, or elevated? You'll see the only red is the FHA delinquency rate. And because it's red, it got 12 points. Now, because of those 12 points, that feeds over to the 30 that we just saw. And that is the culmination of how we're tracking the leading indicators to a crash, because these are all of the signs that led us to past corrections and crashes. And ultimately, we know we're in a wage-based economy. We have to see wages go up, especially when we see the cost of getting the home is getting drastically more expensive.
Wow, this is pretty amazing. And so, correct me if I'm wrong from my notes here. Between 0 and 44, that's the beginning of a seller's market, right?
Yeah, I think if you hover your mouse over depression or if you click depression, maybe the comments are only available to me. No, see, I've
Mm.
been posting comments thinking everyone else could see it. That's I need to fix that. Maybe I could add notes. But yeah, it's 0 to 45. From 45 to 60, we'd be considered what we're in a buyer's market. If we get above 75, correction in sight, above 90, crash in sight, and if we're in the hundreds, you don't need this document. We're actively in a meltdown. You
Yeah.
you won't need the numbers to prove what you're feeling.
Yeah. Wow. No, that definitely makes sense. But man, this is I really like this because it's really meant, for those people like you and I who are, just people on the ground looking at the housing market. Um, and from what I've gathered from from our discussion so far, and what I really don't hear too much about, uh, being discussed within like the housing market discussion, is how much of an influence this private equity, um, I guess, monster is having on this, because this is the biggest problem. And it's like, how can that happen in the United States where it's essentially a monopoly? And from what you've told me before, it's not just a monopoly on, owning and renting, it's also with maintenance or anything like that. um so this is like a full-blown back to front monopoly. And you know I hate to bring it to this comparison, but I mean, you saw this like back even during the ancient Roman Empire, where you had a
Sure
huge
did.
concentration of wealth at the top. And we're just seeing signs of this, right? I mean, it's the crowding out and the increase of the K-shaped economy, essentially.
Ray Dalio is an economist I follow. He has a great video. It's a long one on the changing of the empires and walks through the history of it. And so shows the wealth gap disparity is one of the quickest ways and one of the most telltale signs of the shifting of power. And to get into modern day, what's going on right now with China, next up, it gets me a little bit more on the fritz of thinking, why are we poking the bear that actively wants to take the top spot in the world from us? And they're prepared to do so when we already have these gigantic systemic problems. We already have these huge issues homebound domestically. And I get the long-standing thought, and I'm not here to say tariffs work, don't work. I believe we're poking holes into a system that's just built on air. We've been printing money, bailing out banks, allowing stock buybacks for too long. And ever since we got this toxic asset relief program in 2008 that got used instead for lining banks' pockets right in front of our faces. I mean, you talk about the Fed in their quantitative easing
Hmm.
was made up right then and there. It
Yeah.
wasn't something we've been doing for decades. You never did that in the 50s, 60s. They would have been like, what kind of thought is that? It was brand new.
Yep.
And to say that we're not in uncharted waters, and that's what I want everybody to be able to get off their red and blue horse, to just all commonly say together, we don't know what the plan is. We don't know if the person with the plan has a plan. He may, I don't know. But also, we are in uncharted territory in terms of where our economy stands. And I think things like tariffs or other things that could happen in a week, a month, a year are just blowing air on the house of cards, and it feels wobbly. It feels wobbly.
Yeah, no, I 100% agree. And that was even before the pandemic, right?
Yes. Yes.
The pandemic even
Oh,
injected steroids on that problem, right? So we just jumped almost like a decade and a half of the really bad problems that were being, that were happening. And I was showing this in uh one of my threads yesterday, but a lot of people forget that reserve requirements since
oh,
March 15th.
we got to connect on X. I'm trying to get started on there. I just use it to mean tweet politicians right now, but
Oh, yeah, man. No, I have you right here. Let me give you a follow.
yeah, I have to follow you back. We'll get connected. Yes, sir.
But a lot of people forget that the Federal Reserve lowered reserve requirements to zero, meaning that banks, they do not have to lend out based off of reserve requirements. It's all based off of essentially the rules that are set up now, right? So we're in even more uncharted territory, you know.
Yes.
We are no longer in a fractional reserve banking system. We're in a zero reserve banking system,
Which
which
means every mortgage that's created, every financed car purchase, every financed purchase of anything is creating money in the economy. And we have to think about who's buying the assets. It's not the bottom 50%. It's not hardly even the bottom 75%. It's the top. Yes, there's the upper class of wealth that's getting to take advantage of that too. But the money that's moving toward the seller and the money that's being indebted toward the buyer are both adding money to a system that the lower classes will never be able to get their hands on. And more people need to talk about that. And yes, I have heard the arguments of what do you even go to? But that's the exact problem. We have to have these conversations. We can't just ignore it because we don't know an alternative.
yeah, and for me, it's like I don't even understand what the end goal is for some of these people who are just taking advantage of this. Because I mean, when you take a look at like the longer term like demographics trends, I mean, they say that demographics is destiny. Birth rates are declining like crazy, and quality of life for the bottom 50% is obviously worsening. We've been talking about that, and it's like you know, all this money printing is just going to speed up along the end of the game that they like to play, you know. So it's really, it is interesting that they're choosing that route. It seems just like incredibly short-term thinking, no long-term thinking whatsoever. And it's kind of like the actions that I'm seeing from the elites and things like that. It's almost like they know the game is up and they're just trying to like go out swinging type of thing, you know?
Yeah, that's where my brain honestly, and God bless us and everyone that's listening to this, as we're not going to know the answer until the answer is shown to us,
Yeah.
is I come to a fork in the road. Is either A, they are thinking short term, and we are at the end of our 250-year empire cycle, and it is time for the churn. And it's natural, and it's going to happen, and it's going to hurt. Or there's the other one of it is purposeful. The issues created aren't just some accident. The volatility, the back and forth, the securities, the treasuries, the stocks, I mean, pretty much everything is inflated. And if that were to be planned, and there were to be something on the back end that was waiting for them, like a BRICS led gold standard or a WEF led digital backed currency like a Bitcoin I've heard thrown around,
Hmm.
you would need the dollar to crash. You would need a reason for people to want to shift to that. And the only logical way would be to get people to distrust the dollar, which is a fiat currency. It's only relied on by our reliance on the government, our trust in the government. And
Hmm.
so if that gets tarnished, the dollar gets tarnished. And that's the scarier of the two roads, because then you're talking about UBI and you're talking about work slavery. You're talking about them owning every nook and cranny of your life. So you don't have a choice. Even to get biblical, like you said, spiritual earlier, you're even getting the things like Revelations 13 through 15, where they talk about one world currency, one world order, and one main decision making. It's freaky, but it's ultimately, again, like I said, it's not a room that we're blessed to be a part of. So it's kind of like you kind of sit and wait and see how the cards unfold.
Elon Musk's Neuralink being the sign of the beast.
Man, if you read Revelations 13 and you don't assimilate the wounded in the head leader who speaks audaciously to Donald Trump and the man who makes fire come out of the sky for people's entertainment, that's his helper, as Elon Musk bringing rockets from the sky. It's a weird chapter to read because you're like, oh geez, is this it? Is this them? But it's weird. And
Yeah, I
again, it's
guess.
speculation.
Oh yeah, I mean, I guess there's a reason why not very many churches, you know, teach the revelation part of it. But yeah, I mean, you know, reading that, And that's great that you're a Christian, man. That's awesome.
Yes, sir. Yes, sir.
Um, definitely need more of that in the financial spaces for sure. But yeah, no, it is quite surprising there. It's almost like you got to like double take the words there. But yeah, I think that I guess what we can do from here on the discussion is when it comes to the ways out of this. I mean, we talked a little bit about it just a moment ago, with the inevitable just collapse of all this. Do you see a less painful way, through all of this, to where, maybe some legislation comes out where that limits these private equity monsters to, I guess, be limited in their power to, bring affordability back down? Obviously, rates need to come down as well. Um, I'm not sure if you even see a way out of this that, gets back into where there's a, all right, well, I'll just shut up then.
No, I carry this notebook around with me, and I've gotten that question now in the last 2 years more than I can spit, and it's a valid question. And I don't want to be the creator that's just spouting all the problems without perpetuating also the potential solutions. I will say before reading a couple of these, I don't know what I'm talking about. And B, a lot of these wouldn't get put in place for two reasons: money and power. You get down to the source of it all, and whether you believe it's a big cabal or it's all run by some foreign country or it's 13 bloodlines or four companies, whatever you want to draw the lines to, it comes down to money and power. People want more money at scale. Every individual at scale wants more money, and every individual that has power wants more of it and wants to keep it for their heirs. Whether that's their kid, whether that's an office, doesn't matter. That's what they want. I think there's some easy ones. I think immediately we have to look at abolishing fractional reserve investing. I'm sorry, lending. And I personally think we need to look at either auditing, creating full transparency around, or abolishing the Federal Reserve. There's been 12 bills since 1999 looking to do one of those three things, and not one has made it to the voting floor, except one, and that died in the Senate. I think we tax
Wow.
the wealth. We could create a progressive system that really starts getting gnarly above 10, 100 million. And we're only talking 1, 2% or less, because that amount is so severe in comparison to taxing someone who makes 50 grand at 20, 25%. That doesn't correlate to me. If we really wanted to tax wealth, we would stop taxing income and property, and we would start taxing these income creating assets and wealth. If we actually wanted to, which is, again, to my point, I don't think we want to. Replacing property tax with land tax. I'm just going to read right off this. So I
Yeah,
trying to
go
go
for
from
it.
memory. A 2% fee on corporate landlord home purchases at closing. I think that would be pivotal. I called it an investor ladder. You pay it one time at closing, just like a veteran affairs loan. They have to pay a VA funding fee to buy their house. Pay a fee. If you own 10 properties or less, 2%. If you own 100, 3.5%. Not trying to gouge anybody, but if you were to take that money and move it in the first time home buyer fund that helps first time home buyers get into their first home, you create a cycle of you take a home, and you're helping provide someone else to get into a home. Right now, there's no cycle. The only cycle is buy more, buy more, buy more, buy more. There's no help at the start.
Interesting.
We need a massive public housing investment. We need at least 4 million homes. I'm not sitting here saying I know how to do it, but I would have an all call with the builders and the smart people and the bankers, be like, how do we make this happen? Because it's the only way we see home prices stabilize. We need more supply. And I believe in a vacancy fee. We have a lot of vacant properties. A lot sit in estate and a lot sit with personal owners, but a lot just sit because they sit. And I think if you have a home and it sits vacant for more than 12 months, that you should have to rent, sell, or get taxed on it. And that tax, again, goes to our first-time home buyer fund. I think we could do a debt jubilee of student debt. I think we could create a UBI for the younger generations out of the wealth taxes and carbon pricing. I think we need to start standardizing job training like China and other countries are doing around actual preventative healthcare and also AI and tech. I also think we could incentivize healthcare companies in some way, shape, or form. Maybe they have to remain private. I hate that. But at least enforce something to incentivize a focus on wholeness and We don't want you at the hospital. We don't want you to be diagnosed with the disease. And we know how to prevent it, but we don't because it's profitable when you come here. We need to change that. The government side, though, I think is the biggest one. We balance the budget every 5 years, so it's nonpartisan, and you have to make the budget partially for the next term, too. I think there's too much back and forth, and we reset everything for every 4 years, which is silly. We end stock buybacks and we end board positions indefinitely for anyone that sits in a lawmaking position. We set an age limit on anyone who can sit in one of those positions, and we set term limits on anyone that can sit in those positions. And we also get rid of lobbying. And I know that's a lot to swallow, but I think all of that could get passed if it was all grandfathered. If we said the person signing it doesn't have to abide by it or has to abide by a slightly varied version of it, but then the next person who takes their seat, no lobbying, no positions, term limits, and age limit. And then you change the entire lawmaking system right then and there. And that's when real change could actually come out of it, when we could start enforcing antitrust laws for real. You mentioned earlier, we're living in this giant oligarchic monopoly. And it feels weird that we know one person or three people own everything, but yet they're not technically breaking antitrust law, monopoly law. And the last one I would say is just removing corporate influence from elections. There shouldn't be any LLCs, any countries, any PACs, any metas. Like Mark Zuckerberg, like he shouldn't be at the inauguration front row because he invested billions. Like that's just weird. It's weird that Donald Trump got on today and said, "Buy, baby, buy." Today's the day to buy in the stock market. Like, you're the president of the United States. Please stop talking about when we should invest. That's just a terrible.
I don't know how that's legal.
It's just a terrible look, and exactly, it just doesn't feel legal. Like, you're not that person to do so, whether you believe it's true or not.
Yeah.
So again, I think there's things that could be done. I don't also think I'm a very smart guy. I think I'm just viewing things and I'm thinking deeply about these things on a day-to-day basis because I do want to see change. And I'm getting to the point where I believe that others have figured that out too, and they just don't do it because it's not beneficial to the overarching system. Not to be that guy. It's like, oh, it's the system, but like it's not beneficial to the overarching system.
Yeah, no, it's true. I mean, it's clear by just looking at data how it's not working, right? But man, those are some great notes there, and I agree with a lot of those. Yeah, I mean, I know that you were downplaying your intelligence there, but I mean, your videos speak for themselves, as well as this Trump tracker is pretty amazing. And yeah,
I
for those
appreciate the
people,
kind words. I do a lot of yelling in the car.
no, that's awesome, man. More people need to voice their opinions, you know. But yeah, I think that when it comes to the solution, it seems like things don't actually change until it gets hard enough to where we have to, and unfortunate as that is, I think that a lot of those solutions that you had mentioned, will, eventually get enacted. I just think that a ton of pain has to unfortunately happen first. And I think
I
that,
heard a phrase. Sorry, the Zoom delay got me. Apologize.
no, go for it.
I think I heard a phrase that said, "The only time change happens is when the pain of staying the same outweighs the pain of making the change."
Yeah, no, that's exactly right. And it seems like that's what really happens within the government. And I think the United States has the insane privilege of being the world reserve currency, but if they keep heading down this path, I think that might be taken away from them, which it has all before. Going back to Ray Dalio's Principles book, you see how this happened most recently with the United Kingdom. I mean, Britain used to be the United States of the world, and we saw what happened there. And in between were large upsets and a lot of just people revolting. So we'll see. I mean, unfortunately, it doesn't seem like there could be some type of peaceful change and that everything has to be abrupt. But there's always a first for everything.
Yeah, and you hope that that's the direction it goes, but you're right. If people continue to be fed what they feel is just political propaganda to keep things peaceful and status quo, and we all don't like the status quo, then at some point it might shift.
Well, that's awesome, man. I guess last question, when it comes to when it comes to, I guess, in the immediate term, do you think that, because really the narrative right now is, oh, as soon as rates come down, then you'll start to see demand just soar. But the problem is that housing prices are already still remaining incredibly high. I mean, the average price for a new home is like what, like 520 or something like that.
I think median across the world, right, or across
Median.
the country, it's like 408 right now. But yeah, way higher. It was 272 just 4 years ago.
Gotcha. And so a lot of the solutions were great ones that will happen, over time. They might happen abruptly depending on how crazy things get. But I guess when it comes to that mainstream narrative of, lowering rates will fix everything, what are your thoughts on that?
I would suggest watching the PBS Frontline documentary, The Age of Easy Money. It is the best scenario for people with wealth because the people who get loans are people with stock portfolios and assets that they can leverage against. It's a long documentary. It's a long one. I remember I sent that to my dad about 3, 4 months ago. He started watching. He's like, I didn't look at the ticker. You got to warn me when it's a 2 hour video. But this talks about the loans that were gained by businesses, the loans that were acquired by private equity, even the mortgages we opened with this, the golden handcuffs, the mortgages that people were able to acquire during low rates were the reason why we're here today. I don't think lowering rates would solve everything because you're going to fuel the economy in the same direction it was already going. My theory is the more money we have in our economy, the more aggressive and the more insane the inflation will be when rates are low. And I think we saw a little piece of that with our response to COVID by dropping the Fed rate to zero, by the 10-year treasury following short behind, and people being able to just throw money out there and not really see the consequences. They're locked in at the rate, they're locked in at the mortgage. Yeah, a lot of people bought their starter home and now it looks like their funeral home, but they got a home and they got assets and they got equity. And there's a lot of people that are dumb as bricks that own a home that have 120 grand in equity to their name just because they chose to live in a house instead of rent when it was a choice. Now it's not a choice for a lot of people. So no, I do not think lowering rates solves all problems. I do not like Jerome Powell. I don't like where he came from. I don't like his weird relationship with Trump that seems really friendly at first. And now they do this little public banter thing. It makes me wonder, is that a part of the bigger moves overall? I don't like that all the Federal Reserve is unelected. I don't like that they all come from big banking and hedge funds and private equity. But I also don't envy their position because it's either keep rates high and everyone hates you or lower rates and everyone hates you in 2 years. So I don't know.
Yeah, it seems like what you had mentioned before when we were discussing the Trump tracker here is that one thing that would definitely make things, or one thing that would definitely get housing prices down is some type of depression.
Yes. And that's really the culmination of what it would have to be because you have to think about what's going to get a older gentleman and woman to sell their home forcefully when they don't have a mortgage or they have a payment under 1,300. Why would they do that?
Right.
That's the cost to get a washer and dryer nowadays. That's what they have to pay per month. They're fine. They don't have kids. A lot of them, if they're over 65, they don't have to pay taxes in their school districts. They don't have these abnormal and obnoxious costs that young couples pay to raise a kid or to get childcare or to get a new car off the lot. A used car today is 515 off the lot. Grandpa's had his car paid off for 7 years. They don't care about that. So to get them onto the market, man, it would take a lot of pain, a lot of pain. And one thing I will say, if there's any leading indicator of that pain may be beginning to be felt, recent study that had come out saying, and I can't source it for you, I'm sorry, I don't remember who wrote it, that
Probably look it up.
grandparents and older generations are now taking out more financing to help provide for their kids and their kids' kids because kids have been going to their parents and now parents are getting to the point where they are going to grandparents. So could a transference of wealth kind of happen there? We're getting trickle downy, which we know didn't work the first time. So I don't know. But it's clearly showing that a lot of people are going through a lot of economic issues. And again, getting back to modern day, this tariff battle, this trade war, this I mean, everything down to the Melania coin. It's just weird for me, and it just feels odd.
What, you think we shouldn't put all of our money into fart coin? You think that's a bad idea?
No, no, no. And I just selling watches and boots and Bibles during your speeches. It's weird. I don't get it. It for me also branding wise, it doesn't fit the narrative. I guess some think, oh well, he's a businessman. Like, no, he's a billionaire that you supposedly think can't be influenced by money, but yet he's sitting here trying to peddle a $55 watch. That doesn't make sense to me at all, actually. So I don't know. It all just seems weird. And my political affiliation is green. I want to find the people that are chasing the green and stop it, because the blue and the red I feel is just a distraction. It's a big WWE match in my opinion, but
It really is. I mean, complete agreement there with that. The real enemy is the now zero reserve banking system. That's really what's been causing a lot of this.
yeah.
The politicians on both sides of the aisle are just trying to get on their knees for the banks. And that's really how it's been ever since the creation of the Federal Reserve back in 1913, you know. And so without some type of plan to abolish that system and go back to, you know, being on some type of hard asset backed currency, whether that's gold or Bitcoin or whatever, you know, it doesn't seem like there's going to be any type of end of this boom and bust cycle, credit expansion, credit contraction type of move that's going on. So it's almost like inevitable that we will have some type of I guess, reckoning with another credit crunch. It will just be interesting to see where that comes from. And from this discussion, it almost seems like it's going to be, private equity, instead of crappy mortgages like in 2008.
I mean, you could look at the student loan collapse, you could look at car defaults, you could look at corporate bankruptcy, you could look at the bubble that's been created by private equity, or you could pick your bubble. Like
Yeah,
there's a
pick your
lot of
bubble.
issues. There's a lot of issues. Even the commercial real estate space is weird right now. There's a lot of like reason to think that that chaos could ensue. And if one of those bubbles did pop, it probably would cause that ripple effect that could be a 10x credit crunch involving that private equity, because they're so unregulated. They're basically not basically, they're shadow banks. They don't have any rules to play by. And they ultimately would view a meltdown as a discount rack. So it doesn't take much convincing for me to think that, oh, yeah, they could cause that. They would want to cause that. Not saying they are. Again, I'm at that fork in the road. But if they were, it would probably make good sense.
Absolutely, man. Two more questions and then I'll let you go. I know
Yeah, let's
that's
rock it.
I don't want to take your entire afternoon here.
No, you're good. I'm
One
hitting
was
these.
actually a question and a suggestion from the YouTube. For the depression tracker, is there any way that you'd be able to create a time series of the current column? So it's like you can kind of see
Yes,
like where there's trends.
we are. That is so. We're going to slowly build this out into different tabs. We've gotten some requests already. One is we are looking at having something that allows someone to mess with the depression tracker, so you can play with the numbers to see what it would actually take to get us there. Um, the other
That
one
would
is,
be
yes,
cool.
we are looking to create. Yeah, it's like a trade. I'm a sports guy, so it's like my sports games. They always had little trade makers. You always try to make that trade that jacked everybody up.
Yeah.
We are going to put stamps on the time each month, if not each week, depending on the statistic. We're not sure how that's going to get logged or where it'll get logged. My initial thought process was that it would be a something on a separate tab altogether. But yes, we do
Okay.
want to have that because we want to see, like, especially the key three. How has that moved over time? Is it up or down year over year, month
I
over
was just
month?
about to say.
Yeah. If I especially want the key three to, like, next month, I'm hoping you'll see a red arrow up, or I'm sorry, a red arrow down or a green arrow up to assimilate, is this up or down from last month, last year? But this was a video idea from 4 months ago that spiraled into this. And it's really only been like 6 or 7 hyper focus sessions to get us to here. I think there's a lot of legs on it, but I think there's a lot more that can be done with it. I've had people say it should become a website. Um, I don't know the first thing about that. So I'm just going to keep making content and hopefully build on this. But Yeah,
Gotcha.
dude. I think it's definitely a need to see how it's improving or not improving over time because ultimately it's a tracker. We need that.
Yeah, no, 100%. I think this is such an awesome tool, and I can't wait to see how you develop it, from here, man. This is awesome.
Thank
And
you.
yeah, to your notebook thing, I keep a notebook as well, full of notes and stuff like that. Everyone needs to grab a notebook, even if you're just writing something down where it's like, man, the sky looks really nice today. It's a lost art, I feel like. People just don't write things down. It's almost therapeutic.
It is.
People need to get a
And
notebook and just write stuff.
and with the side of the notebook, I'll say for me, I'm not much of an artist, but also just bringing up little graphics. I talked about Jenga as an example of our economy, and I drew that out, talking about. I don't know if this will focus. It probably won't, but I'll bring it back here. Boom, bam, bop. I don't know how this camera works. I'm sorry. Oh, there we go. Past the focus window of how our wealth gap is almost like Jenga. You take from the bottom and you put it on the top. You're not allowed to take from the top three.
Wow.
And the whole point of the game is to not make it collapse. Then the
Wow.
game's over. So that's why we get bailouts and we get these inflationary efforts through quantitative easing to keep the game going. Because once the game collapses, the game collapses. But we all know the inevitable end of Jenga, no matter how good you are. And I think people are feeling it. We're feeling this. We're feeling the unstable base of our frontline workers, of our normal everyday wage workers not being able to get by and survive. I don't think that's sustainable. And some commenters will be like, you're an imbecile. Okay, I just don't think it's sustainable. I'm not trying to whine and complain. I really worry for my younger brother. I really worry for my sister-in-law who just were born 6 years before me. But it seems like I got this 10-foot ladder that I had to climb, and then I hand them the 10-foot ladder to climb, and they look at their wall and they're like, wait, this is 30 feet.
Yep.
You know, I can't teach people the rungs I climbed because those rungs are either rotted or the wall's too tall.
No, that makes total sense. And to your Jenga drawing there, it's almost like how, on the second drawing where, there's pieces taken from the bottom and put up top, when it's about to collapse and you start to see it sway, then you have the central banks come in with a whole nother box of Jenga to fill in those, and then it just keeps on getting higher and higher.
Yeah,
And
and
the
they're
bottom,
putting supports on the side, like, you know how it's cheating to touch it? They're just like,
yeah.
like,
And then before you know it, you have a Jenga tower that's like, 15 feet high, and there's only one last piece that's holding the entire
and have
thing.
you
And
ever
and, it,
played
and the
Jenga with not with more? I love your idea of more blocks, but the big blocks. You ever played that at like a bar or something like that?
yeah,
When that thing collapses, it's not like when the little one collapses. It's like, oh, look, let's put it back together. When that one collapses, everyone in the bar looks over. You're like, holy shit, that was loud.
yeah.
I feel the longer we keep going and adding bricks to the top, like you said, and stabilizing it, that the fall is just going to be that much more dramatic. But of course, that's just a board game. So it's not
Yeah, that it's almost like you start with a small table game of Jenga, and then it gets higher, but the blocks also get bigger. And before you know it, it's just like crazy. Man, that's a great analogy there. That's pretty awesome. Maybe there's someone who's watching who's an animator who can do that. But
do it. Do it.
last and final question, I promise. I know I said that like 3 times
Dude,
already.
my wife was waiting around to see if I was going to be able to go with her to go pick up her daughter. She left 20 minutes ago, so it's all good.
Last question, I promise. And I can ask you this because you are a realtor. What would be your advice for someone who is maybe, like you said, like your younger brother, or someone who is, maybe they have a great entry level job that's paying well, but they see that, you know, they don't really have a shot, and maybe they have to rent for a little while. I mean, what would be your recommendation for someone who might be not quite in the market yet for a new home, but they're still trying to look for one, and they're really not sure. They don't want to be in a golden handcuff situation where now it's like, yes, their rent was 2,500. They just bought a house. Now their rent is, or now their mortgage is 4,000. And it's like, man, great. I have this home, but I'm stuck in golden handcuffs. Oh, great. Now the AC just broke, 10K out the door. Oh, so what would be your, I guess, advice for people like that?
I'll give three. and one's shooting a little far out. So that's for somebody that's looking to buy in 6-12 months. But here's
Okay.
what I would say, maybe 3 to 6. One, it is no longer just about credit and a down payment. You need to have income.
Yeah.
And to have that income measured towards your mortgage, it needs to be followed with low debt. So anything that's associated with your Social Security, not your power bill, not your Taco Bell order that you get every night. Like, they're not looking at that. That may not be best, but they're not looking at that. So as long as you have income, and what I normally say is you need to be able to be making 2.5 to 3 times what your mortgage is going to be after tax, which is a harsh reality for a lot of people. And that's the first thing I tell people, because a lot of people stop me right there like, what? But that's the case. I don't want you to be house poor. I don't want you to walk into that HVAC job that's going to make you call me again saying, I got to sell. I don't want you to go through these 100% financing programs so you're upside down. I want you to be able to own this and have equity. I'm not in the game of getting commission. I'm in the game of getting you to the point where you have equity. So the second thing I would tell anybody is you do have to still have that down payment, but go after the 3.5. There's so many people that want to put 10%, 20% down to avoid PMI. Get into the house. Get into the house, because the asset of a home is the gateway drug to wealth for the middle class. If you don't have it, you will be beaten by inflation. You have to. And it doesn't require the golden hands of owning stocks or crypto. You just live in it. And if you live in it, the equity is going to go up, because guess what? They're going to drop the rates, or they're going to inflate via different measures, QE, or whatever they want to do with a bailout. It's going to happen. It's going to happen. And that's going to lead your home price to go up. So you're going to have equity. But the third part of it is there are companies that are trying to grow these, how do I say this, super apps. We saw it on the real estate side first with Zillow as agents. I was connected deeply, and still am. He's my guy. Tom Ferry. He's a big real estate coach. Any realtors or lenders on the call, you probably heard of Tom Ferry. And I remember sitting in a room with him, and we were talking, and he brought up Zillow and what their game plan was going to be, and why Quicken Loans was shortly there behind for the consumer. And what they're trying to do, Zillow, is they've slowly bought Dotloop. And then they slowly bought Follow Up Boss, a CRM, and Dotloop is an e-signing platform. And they've slowly purchased all of these different key ingredients to the super app for an agent. Zillow drew a clear line in the sand that they were heading toward agent dominance, and that the homeowner wasn't going to be necessarily their number one play. That's why you see people like Homes.com going for what seems to be like the next opportunity, because Zillow's not putting all their effort into it. But Quicken is now creating the super app for consumers. They and Redfin are trying to go after having the agent, having the lender, having the title, having the insurance, having everything. And what that is going to do is going to bring a benefit to the consumer. And that's in what I'm already seeing with, and I can't say the name of it because I'm being added to the board of advisors, and it's still not a real company yet. They, and shortly behind, more already doing it, are offering bought-in programs to get rates lower. They realize rates are the biggest problem. And so they're actually building out platforms that allow them to cut costs enough that they can do what's called like a 2-1 buy down. So they can get you a 2 interest rate drop on the first year, a 1 interest rate drop on the following year, and you hope by the third that it's, lower. But you have to qualify based off that year. But it gives you that cushion. So I would say seek out what's called a 2-1 buy down. And here in the next 3-6 months, I think there's going to be more companies to go right out and say, we're going to get you 2% less. We're going to get you $500 less, or whatever they want to market it as, on their mortgage. And it's a legit program because they're cutting out underwriters on the back end. They're utilizing AI and tech, and they're cutting costs. So my main 3, you got to make money. You got to have money in your account. And I want you to save as much on the monthly payment. So programs like 2-1 buy downs right now are usually the best way to actually get the mortgage payment lower. Because I know so many people that have 20K waiting for their down payment, but they make 60 grand a year. And then I see the other one where someone makes 100 grand, but they got 2 young kids, and they're like, I don't know how to save. I'm paying 3 grand in rent. I'm paying $600 for groceries. What money can I save? And so it's a catch-22 on both ends, but unfortunately it still remains the requirement of the bank.
Yeah. No, I agree there with making sure you have the income available, and maybe with the next type of credit crunch, maybe the income to what is it, the income to home ownership ratio, or I forget the ratio that we were just talking about a little bit ago, but maybe that will come down a little bit, as well as taking advantage of those lower rates. Let the bank do most of the work, as it can, right? Instead of putting down like a 20% on a home, or 10 to 20%, like you were saying. And then the 2-to-1 buy downs. That's interesting. I haven't heard about that program, and it seems like those could be getting more popular here.
I believe they will. I also believe they're a band-aid. I don't believe they're a permanent solution, but I also don't believe there are really any permanent solutions right now.
Gotcha.
So I think that you'll be seeing more band-aids. I think those band-aids could expose themselves in the future if rates don't get better. I'll finish it off with this. 2008 is often compared to today, and how could we get to another housing crash? But I would encourage you to look into what caused it. I would encourage you to look into the history of what led to that crisis, the Lehman Brothers fault, and the ticking time bomb that JP Morgan and Goldman Sachs were handing different companies with these terrible, terrible conglomerates of debt, and handing to Australia. And Australia actually won their lawsuit saying, you guys tricked us. Like, there's so much that doesn't have to do with housing. And I'm not saying that doesn't happen, but because that happened, it exposed a market that was vulnerable, and it was people who had mortgages that shouldn't have had them. That variable's not there anymore. So even if it happened, we're not going to see people with their pants down. Was it Warren Buffett who says, you see who's swimming naked when the tide goes out?
Yeah.
You're going to see a lot of people in full bodysuits. 39.6% don't even have a mortgage. 60% have a 4% or less. It's not going to happen. I would encourage you to look at the history, and you brought it up. Maybe not Rome, maybe not France. The raiding of Bastille had to do with a wealth gap issue too. But maybe 1929, a wealth gap fueled Gilded Age that culminated into a depression because we were just spending. Rates were really low. They were encouraging us taking out debt to make investments into the stock market. And all of a sudden, one bank failure created the domino effect that led to thousands of bank failures. I'm sorry, hundreds, not thousands, a lot. Which is why in 2023, when we saw that one fall, they immediately jumped in and said, no, please, it stops right there, because it can happen fast. And I think something like a private equity, a student loan, a corporate bankruptcy, some type of bubble cause that domino effect. The question always then becomes, does the Fed step in and just print away to keep it from happening? Or do we finally stop kicking the can down the road to an inevitable collapse? But that's kind of dark, so I don't want to end it there.
Yeah, we'll definitely end it there. And it seems that really historically, whenever the Fed and the government have the option in a crisis to choose between kicking the can down the road or experiencing actual pain and responsibility, they choose the former rather than the latter. So, but I think it is important to not get bogged down and depressed by a lot of this stuff. Really just try your best to increase your income, like you said. Save as much as you can, and just take advantage of opportunities, because 2008 was a great opportunity for people who did have some dry powder on the side. So this is definitely an important point to risk manage, which is what I help people do. But Zach, dude, thank you so much for your time here today. I think the audience really liked it. For those who are watching online here on YouTube, I will go ahead and leave a link in the description below for the Trump tracker, as well as if you guys have any type of questions for Zach, I would highly encourage you guys to follow him on TikTok, as well as on Instagram, as well as on Twitter as well. Got to get this up. And yeah, I really appreciate your time here, Zach, and hopefully we'll be able to do more of these in the future here, man.
Yes, that sounds great, friend. I look forward to that, John.
Awesome, Zach. Well, you have a good rest of your day, brother. Everyone, we will catch you in tomorrow's daily macro update. Good luck out there, and we'll see you later. Bye.